Welcome to our Meet the Manager series. Today I'm speaking to Tom Millner, Portfolio Manager at BKI Investment Company, which is a listed investment company. And we're going to talk about how Tom and his team approach dividend investing in the Aussie share market. Tom, welcome to the show.
Thanks for having us.
No worries. So Tom, can you give us a bit of a background on who BKI is and Contact Asset Management? How do these two entities fit in together?
Well, BKI listed on the market 14 years ago. We were spun out of Brickworks Limited. They bought a roof tile business in 2003 and needed to raise some capital. They had a very good established share portfolio, which they brought to market, which became BKI. In about 2005, Soul Patts became a shareholder.
Yep.
So we've always had a parent in Brickworks or Souls, sort of steadying the ship, if you like.
Yep.
But we've been listed now for 14 years. Total shareholder returns, including franking credits, are over 11%. We've got a very attractive management agreement in place with Contact Asset Management of only 10 basis points. We've got 15,000 plus shareholders, and we try and aim at paying a 6% fully franked or grossed up
And
yield
$1 billion
per annum.
portfolio, right?
And $1 billion portfolio, which has grown from when we listed about 172, I think, from memory.
Okay. So your strategy, your investment philosophy is to provide a fully franked dividend that grows over time, right?
Correct.
So how do you approach portfolio construction and the selection of underlying securities to deliver that outcome?
Yeah. Well, I think if we go back a step and just and have a look at Contact Asset Management, Will Colbert and I own Contact Management with Soul Pattinson.
Yep.
We do that for only 10 basis points because we are also shareholders in BKI, all three of us. So I think when we look at our process, that's the first point of call for us. We've got to be aligned with shareholders and know what they want. And as you said, the fully franked dividend is obviously very attractive to them. So step one in our process is income.
Yep.
We look at companies that provide a growing dividend, franking credits. A good dividend yield is also very attractive, but the stability of that dividend and also franking credits is also very important. Payout ratios, if they get too high, we get a little bit concerned. So it has to be well managed in that sense. The second point of call, we look at the stability of the business, i.e. balance sheet and financial strength. Because we saw in bear markets like the GFC, when companies had too much debt, the first thing that was cut was the dividend to help them get out of trouble from a debt point of view. So that's also very important. Management, who runs these businesses. We spend a lot of time on meeting management, meeting boards, going out to site, understanding the business. Because there's learnings from Souls of 120 years, and one of the biggest learnings is you've got to have good managers managing your businesses. So that's one of our key aspects. And alignment for managers, CEOs, MDs is also very important. Then we basically look at valuations, and because we're an LIC with a closed fund, we don't have to pay out redemptions or we don't have to take money in bull markets. We can look at a company over a long period of time, and if it's trading at a premium to what it's worth, we'll wait for a pullback. Likewise, if we see something that's overvalued, we basically just hold it if we still like the company.
Okay.
So that's basically our process.
So let's focus on the dividend payout ratio a bit. Yep. This is something that some commentators have pointed to in the last year. In the large cap space, in the Aussie equities market in particular, you've got some companies paying the vast majority of their profit out as dividends, and you look at a consequence of that, Telstra.
Yep.
So as a dividend-oriented manager, how do you approach companies which are, paying a great dividend, but potentially not reinvesting back in their business?
It's a really good question, and I think as long-term managers, we're holding stocks in this portfolio for seriously sort of 5, 10, 15, 20 years. You've got to have a management team that are prepared to invest for tomorrow. No good worrying about what next half's EPS is going to be or 6 months EPS numbers are going to be. You've got to redeploy that capital in the business, R&D, capital expenditure, invest in your staff, invest in your products. So when we see a payout ratio of 90 to 100%, the alarm bells ring.
Yeah.
Ideally, if we see a company paying out anywhere between 50 and 70%, we're very comfortable.
And is that something you push management to do, or do you just walk away?
Yeah, we're not sort of pushy investors. Yeah. If that's what you're sort of alluding to, we're happy to sell the stock.
Okay.
If the payout ratio is too high and we see the dividend is going to come under pressure, we'll lighten off. BHP was a classic example a few years ago with their progressive dividend policy. I think at the end of the day they were going to have to pay out 220, 230% of earnings. It's just simply not sustainable. And as a result, the dividend got smashed.
Okay, so as the listed investment company markets boomed, we've had a lot of questions from our audience, and one good one was, where does a LIC sit in terms of the account structure? Is it better inside or outside super? Would love your thoughts on that.
Yeah, it's an interesting one. Obviously depends, obviously being a bank, it all depends what the client's needs are. But I think at the end of the day, what an LIC can provide with its fully franked dividends and its high payout ratio, because we do chase those earnings and dividend streams, it can fit in anyone's portfolio. It can fit in someone in accumulation phase, and we see a lot of BKI shareholders in particular buying shares for kids and grandkids.
Yep.
So accumulation phase, it still works. Someone on the highest tax bracket, a fully franked dividend is very attractive. Someone in a super fund, it's very attractive. And someone at pension mode is super attractive. I think the beauty of the LIC is it's so simple, yet so diverse. And if you look at what Contact's charging BKI at only 10 basis points, it doesn't cost the investor a lot of money either. So those franking credits get passed on to shareholders across every group, which is very important.
Okay, let's talk about some risks to your business. So you've got a $1 billion portfolio. That's a lot of capital that shareholders have entrusted to you, but you've got just 2 portfolio managers. Is that right?
Yeah.
So how do you manage the key person risk?
That's an interesting point. I think in funds management, a lot of funds management teams are based on one head portfolio manager. We've got 2 at BKI, which is quite good. So we're trying to diversify that risk, if you like. We also have 2 analysts at Contact, but we also have a very savvy and active board at BKI. Rob Millner, Ian Huntley, Alex Payne, David Hall. Yep. They're effectively analysts and portfolio managers as well. So we've got a very diverse team. I think a lot of fundies probably would like to think they're a key man risk, but at the end of the day, I think everyone's replaceable, and I think a long-term steady business at BKI could be, Will and I could be easily replaced.
Okay, and just one more question, if I may. One of the other risks with LICs is, that potential of trading at a premium or a potential discount to net asset value. And when it does trade at a discount to net asset value, what's your message to shareholders?
Yeah, when we started at BKI, we traded on quite a significant discount for many years, and I think it got down to 15-20% discount, and a lot of shareholders were worried about that. How are you going to close it? You're going to do buybacks. One of the things we weren't going to do was do a buyback, because we wanted to grow the business and get scale and get liquidity, and we've done that. We've now got over 15,000 shareholders and managing $1 billion. So we've grown the business quite well. So I think the easy out on a discount is to have a buyback in place, but that just shrinks your business and makes it harder in our view. Longevity, doing what you say you do, getting out on the road and talking to advisors and planners and brokers is very important to us. So lifting the overall awareness of BKI has been at the forefront of Will and my mindset over the last 4 or 5 years in particular at BKI. Then at the other end, at the premium, you run the risk of not encouraging people to come onto your register because they're paying too much for your business. But it does, open the door a little bit to have capital management initiatives and capital raisings, etc., etc. But ideally, you want to probably trade at a 5% premium or 5% discount and let the market work it out themselves.
Okay. Tom, thank you so much for coming in.
Good on you. Cheers.
I hope you enjoyed that video. Please remember, before acting on any information, do your research and consider seeking financial advice. My name is Vishal Teksanani, and I'll see you next time.